Hello, with me today I have Sam Wahab, oil and gas analyst at broker SP Angel. Now, Sam, the energy markets are grabbing the headlines again. Rising natural gas prices, petrol shortages, and rising energy bills have all started talk of an energy crisis, especially coming into the winter. Should the general public be worried?
Yeah, I think overall it is quite a big concern for the general public. I mean, we've seen a run on the fuel pumps over the last 7 days, which are unexpected from a certain extent. But I think we forecasted when we spoke a little while back that this could potentially happen with the lack of investment. I think there's a few other things feeding into the current issues that we see in the wholesale gas market and the run on fuel pumps. Firstly, the fuel pump issue, I think, is fairly separate. That's an issue with Brexit and taxation changes in the UK with regards to IR35, which has led to a drop-off in HGV drivers. So therefore, the logistical methods of getting the fuel to the pumps has just not been there and been in place. And we saw last week BP, with their own strange attempt to put pressure on the UK government in that respect, have spooked the market. And so we've seen a 300% rise in consumers at the fuel pumps, which has invariably led to that running out. So that's where the issue is of that. But in terms of wholesale gas pricing, that's clearly been a number of issues that have hit the market. But I think consumers will be worried. I think personal balance sheets will start to become more stretched. You look at as well that there'll be more tax changes coming into effect next April, which will increase the level of tax that we have to pay on national insurance, which will also squeeze those budgets, and then usually feed into the fact that I suppose we'll come on to talk about inflationary issues that we're likely to face in the medium to long term. But generally speaking, that would mean that the Bank of England will increase interest rates, which again will put up mortgage payments, etc., etc. So yes, I do think overall the general public should be very concerned, and I think wholesale commodity pricing will continue to be elevated to a certain extent that it is today.
It's the gas prices that people have been talking about, but what's really behind the surge in those gas prices, especially in Europe? Is the situation easy to resolve and for prices to fall back again?
No, I don't think it is in the medium term. I don't want to be too doom and gloom about this whole thing, but it really is a perfect storm of disruption that we've seen over the last 12 months. There's been a lack of investment in commodities since the pandemic, given that demand just hasn't been there. Now it's returned quite quickly, and we simply don't have the resource available to meet that growing demand. So people are stockpiling. Also, if you think back to last winter, we did have quite an extended and protracted winter in Europe, which meant that supplies were drawn down, inventories weren't replenished. We were 25% below where we normally are with regards to gas stockpiles or any energy stockpiles. Then you add into this perfect storm where there's been certain disruptions through the Russian logistical barrier. There's been bottlenecks there. There's been in Norway as well. There's been some shutdowns in key fields. The Forties gas infrastructure that we have here in the UK North Sea, they closed in 67 odd fields for 3 weeks in June. And then you throw into the mix the fact that we have had a lack of wind in the North Sea, so the wind farms haven't been able to produce. So it has been a real perfect storm of lack of commodity and a return to requirements to supply. So that's really pushed these the whole gas dynamic up, and it's led on to into the domestic market, where I think we're going to see higher prices longer for at least now for the foreseeable future. I'd also add as well that the growing interdependence between some of the regions amongst the world, so the large ones, the US, Europe, and Asia, they are all independent. They buy LNG from each other, and we're seeing that when one region struggles, the others get directly affected, and that's becoming more and more prominent. And I think that will be the case for the future.
Well, one would imagine that sort of governments will act to try and avert a more fully fledged crisis, I guess. But what if they don't act fast enough? Is there a trigger that could cause a fully fledged crisis as we head into the colder winter months?
I think, exactly that if we do have a severely harsh winter, not too dissimilar to what we had last year, we will start to see this crisis deepen. And I think we already are entering into some sort of crisis. I'm not sure how much government intervention can happen by now unless even if they stimulate North Sea or European investment into commodities. The life cycle of a generic gas field is usually, from exploration to production, is usually 5 to 6 years. So there's nothing immediate that can be done. They could probably reduce tariffs to ensure that there is more supply, but we're still at the mercy of, it's typical of this business, we're still at the mercy of these shocks that happen. So such things as the fire that happens in France, or not having enough wind in the North Sea. These things are well outside of our control, and I don't think the government can in any real way alleviate something that they're at the mercy of, of something they can't control. So for the medium time, we're teetering on the edge of a crisis, and I think that would be one of the biggest concerns going forward.
Okay, well, I mean, investors might be rightly concerned about their portfolios and be looking at their holdings and wondering whether they should do anything. I mean, are there any companies whose share price could actually benefit from the current situation and any escalation in the crisis?
Yeah, absolutely. And I've looked at a couple over the last week or so. Clearly, most natural resource investment portfolios we weighted towards what is capturing the upside in the current gas price surge. So a couple that I think are certainly worth looking at. Serica Energy this morning put out their interim results, which were very strong indeed. We saw revenues in excess for the 6 months, the first half of this year, of £100 million, with over £40 million of profit, and that's swinging from a loss in the first 6 months of last year of only of a £20 million loss. So, and if you feed into the fact that they're bringing the Columbus development well in the North Sea back on stream after the successful drilling of that, as well as the Room 3 well, which started producing in August, so we're not captured in these results, will lead you to see that you're going to have a much stronger second half of this year. And so, the operating profit of that particular company is going to be extremely favourable, and I think that's one that investors should severely pay close attention to. I mean, the share price is already up 100%, but I think there's still a hell of a lot more running room to go in that particular stock. And another one that I recently looked at, which I think has been overlooked by many investors, even though it does have a strong investor base, is Deltic Energy. They also operate in the North Sea. They're due to be drilling. They've got some strong industry partners alongside them. I mean, first and foremost would be Shell, where they'll be drilling the Pensacola prospect in the North Sea in 2022. But interestingly, they brought a new partner in, Cairn Energy, and these were over 5 licenses where they farmed out 70% of their southern North Sea basin prospects. This will be partly financed by Cairn, but it's also interesting the fact that Cairn have not operated in the southern North Sea before. They've had other areas within the wider basin, but this would be the first foray into that, and it sort of adds to the validation that they have something very, very interesting there, and potentially quite a prolific acreage position. And given that they already had a relationship with Shell with the Saline and Pensacola prospects that they found out previously, it goes to show that that would be their first port of call, but the more attractive offer was probably coming from Cairn here. So I think that's been flown under the radar to a certain extent, and I think that would be one compelling investment opportunity for investors.
The price of Brent crude is currently in the high $70 a barrel. That's a 3-year high, thereabouts. What's the outlook for oil prices near term?
Yeah, I mean, Lee, this goes back to our last conversation where we sort of forecasted a spike to the upside as and when, given that we've had a contraction of 5 years worth of underinvestment in exploration, all taking place in 1 year during the pandemic. So we knew that there would be a lack of supply and quite a skewed sort of hockey stick view of demand coming back in play. The pandemic meant that everything was shut off and then instantly returned thereafter. So there was always going to be a massive correction to the upside. It's how we deal with that going forward. I personally think, I mean, we've moved over $80 per barrel Brent today. I can see this running further and further, because even if you look at, say, the OPEC plus dynamic where we sit today, they're increasing production by 400,000 barrels a day per month, every month until we're back to pre-pandemic levels. That's clearly having no real effect on taming the oil price to in any major way. You add into the fact that there's been a relaxation of pandemic restrictions that we've seen. We only saw Japan this morning completely ease their restrictions. We've seen it across Europe. In the UK, we're pretty much back to normal in the sense where we once were. And again, travel restrictions are starting getting eased, week by week. But we don't still have the supply to meet that. One of the reasons for that OPEC have been open with is that the ability to maintain their oil fields and gas fields during the pandemic just hasn't been there. So they've fallen into slight disrepair, and therefore increasing their quotas by this 400,000 barrels a day has proven to be a struggle for them. They're not meeting all of their quotas as it stands. The oil price is pushing on, inflation is increasing. So we're lurching into another issue that I believe should have been foreseen by the major governments around the world. And it goes back to what I mentioned earlier about the interdependence of the energy mix between major regions, that is probably more prevalent in oil than it is in gas, but increasingly more so in gas. But we're seeing the Chinese stockpiling crude. We're seeing the US failing to meet some of their demand requirements. And all this is feeding into a global mix, which is seeing oil prices escalate. And I have to say, I agree with Goldman's forecast that they see a near-term push to $100 per barrel Brent.
Well, that was going to be my next question. I mean, in what circumstances might the price of oil hit $100 again? I mean, how likely do you think that is? I mean, difficult without a crystal ball, but I mean, over what period of time do you think?
I think it's extremely likely within the next 12 months. If you look at the supply-demand dynamic, we're only consuming more at this stage, and the supply just simply isn't there to meet it. And there's a lot that feeds into the oil price, interest rates, inflation, and everything else. But it's really falls down to supply and demand, and our expectations of future contracts like WTI, and where we're going to be in 6 months' time. And currently, as it sits, we simply don't have the supply to meet what is an ever increasing demand. And in terms of things like ESG and using renewables to fulfill this void, I think what the last oil and gas price rally has demonstrated is that we are not currently, even in the West, set up for renewables to sufficiently fill the void, to fill the gap of a correction in oil and gas. And we're even having to bring in potentially coal to fill some of that void, which is sort of going to the other extreme of what the energy transition is all about. So yeah, it's going to be a testing time, and it'll be an uncertain time. I can't disagree with that. But in terms of it getting to $100 per barrel, I think we're talking within the next 12 months.
Now those high oil prices clearly have a positive effect on oil sector share prices, and both BP and Shell have done very well recently. I mean, of the heavyweights, do you have a favourite energy company to play the theme?
Yes, I do. I mean, and you're absolutely right about Shell and BP. I mean, Shell's up 27% year to date. BP's up 34%. And I'd add as well that BP was down to 180 pence a share over the last 12 months as they all got hit during the pandemic. Both companies have notoriously been sort of heavy dividend players. And I think, as we spoke last time, Lee, that Shell had just cut their dividend for the first time since the Second World War, and there was, they lost a lot of income fund investors on that, and so both stocks took a dive. I'd also say that I don't personally believe that BP has ever fully recovered since the Macondo spill some years ago, and it's always been trading below fair value on that. One thing I would add, then, they are attracting a lot of new investment, mainly due to both committing to ESG and the carbon neutral position by 2050, some of which, like the Exxons and the Chevrons of this world, the US heavyweights, they don't play that game. They're sticking to hydrocarbons for the long term. But what we have seen is both companies start to increase incrementally their dividends, and what we really need to understand about these companies, first of all, they're ticking the box of the ESG investors, but they're also generating significant cash flows. some of which they have never done in their history. They've removed a lot of the operational cost base during the pandemic, which we saw, but then commodity prices have completely ramped up, which means that their operating profits and ability to pay these heavy dividends have now returned. So I think there will be a lot more focus towards them. In terms of, if I were to pick one of the two, it would probably be BP. I think they're undervalued anyway. But I also think that they've got, geologically well diversified and geographically well diversified, in addition to having the strong dividend as well as the operating profits that I mentioned. I think they're completely undervalued, and not that Shell isn't undervalued, but I just think if I were to pick one of the two, I'd probably see more upside in BP today.
Fantastic. Sam Wahab, oil and gas analyst at broker SP Angel. Thank you for joining me today.
Thank you.